Hi, I'm Andy Temte, and welcome to the Saturday Morning Muse. Start your weekends with musings that are designed to improve financial literacy around the world. Today is September the 27th, 2025. Last week, we traced the ancient art of sharing risk from Babylonian merchant caravans through medieval guilds to the Great Fire of London in 1666. We discovered how humans gradually developed methods for pooling risks and pricing uncertainty, but it took a London coffee house to transform these scattered innovations into the systematic insurance markets that protect our modern economy. Today, we're stepping inside Edward Lloyd's coffee house in the 1680s to witness the birth of modern insurance and discover how the mathematical principles that we've explored thus far converged to create an institution that would revolutionize financial markets. Picture London in 1688. The Bank of England won't be established for 6 more years. Coffee houses are the city's social and commercial hubs, serving as informal exchanges for news, gossip, and business deals. But Edward Lloyd's establishment on Tower Street was a little different. Lloyd had discovered something crucial, that information is the lifeblood of insurance. His coffee house became the unofficial headquarters for maritime trade, ship captains reporting weather conditions, merchants tracking cargo arrivals, and underwriters seeking information about vessels and routes. Lloyd realized that reliable shipping intelligence was worth more than the coffee he was serving to his customers. He began posting detailed shipping news on his walls: which ships had arrived safely, which were overdue, which had been lost to storms or pirates. This information service attracted exactly the clientele who needed marine insurance the most. By the early 1690s, Lloyd's Coffee House had become London's unofficial maritime insurance exchange. Merchants would arrive seeking coverage for valuable cargo, and individual underwriters, who were wealthy men willing to accept maritime risks in exchange for premium payments, they would gather to evaluate and price these risks. What made Lloyd's revolutionary was the development of a unique risk-sharing system that solved problems that plagued earlier insurance efforts. At the time, traditional insurance required finding a single insurer wealthy enough to cover large risks. If a merchant needed £10,000 in coverage for a valuable cargo shipment, which was an enormous sum in the 1690s, he needed to find one underwriter with both the financial capacity and the willingness to accept that exposure. Lloyd's pioneered what we now call syndicated underwriting. Instead of seeking one massive underwriter, merchants would divide their risks among dozens of individual underwriters, each taking a small portion of the total exposure. One underwriter might accept £500 of risk, another £300, and so on until the entire £10,000 was covered. This system solved multiple problems simultaneously. It made large risks insurable by spreading them across many participants. It allowed smaller investors to participate in marine insurance profits without facing catastrophic losses, and it created a competitive marketplace where premium rates reflected true risk assessments rather than individual underwriter capacity. Edward Lloyd understood that his coffee house's success depended on providing services that insurers couldn't find anywhere else. He pioneered several innovations that are central to modern insurance. Number 1, Lloyd began publishing Lloyd's News in 1696, the first systematic shipping intelligence service. This provided detailed information about ship arrivals, departures, and losses, crucial data for pricing marine insurance accurately. Second, Lloyd also established standardized procedures for recording insurance transactions. Each policy was carefully documented with clear coverage terms, premium payments, and claim procedures. The standardization reduced disputes and made it easier for merchants to compare different insurance offers. Third, and most importantly, Lloyd created the first systematic reinsurance market. Underwriters who had accepted risks could transfer portions of that risk to other underwriters, spreading risks even further and creating multiple layers of protection. Now, the Lloyd system worked because it applied mathematical principles that we've discussed previously. Remember our exploration of compound interest and how predictable patterns emerge from seemingly random events over time? Well, marine insurance operated on similar principles. Individual ship voyages, they were unpredictable. Any vessel might be lost to storms, pirates, or mechanical failure. But across hundreds of voyagers, loss patterns became remarkably consistent. Experienced underwriters learned that approximately 2 to 3% of ships were lost annually on a typical Mediterranean route, while dangerous passages to the Americas might see 5 to 7% losses. If historical data showed 3% annual losses on a particular route, underwriters could charge premiums of 4 to 5% and expect profits over time, even while paying claims on the unfortunate 3% of voyages that did encounter disaster. This mathematical approach connected directly to Edmund Halley's actuarial work that we talked about a few weeks ago. And remember, Edmund Halley was the astronomer who had created the first scientific life expectancy tables. Halley applied statistical methods to human mortality, creating scientific life insurance tables back in 1693. Now, by 1700, Lloyd's Coffee House had become central to London's maritime insurance, with influence extending throughout Europe. International merchants sought Lloyd's coverage for worldwide trading expeditions. The coffee house attracted underwriters, merchants, shipbuilders, naval architects, and maritime lawyers. This concentration created cluster effects when related industries locate together, generating innovations and efficiencies that everyone can benefit from. Lloyd's also pioneered quality control in insurance. Underwriters required detailed ship surveys before providing coverage, leading to improved construction and safety procedures. They offered premium discounts for vessels with experienced captains, encouraging professional maritime training. Now, Edward Lloyd died in 1713, but his coffee house continued operating under new management. In 1769, a group of regular customers created New Lloyd's Coffee House in more formal premises, establishing clear membership rules and governance procedures. And over the following 100 years, Lloyd's grew from an informal gathering into Britain's dominant insurance marketplace. By 1871, Lloyd's had become so central to the British economy that Parliament passed the Lloyd's Act, formally incorporating it as a legal entity with the power to make its own bylaws and regulations. What began as a maritime merchant's house sharing information over coffee had evolved into one of the world's most important insurance institutions. You may have heard of Lloyd's of London. That's what we're talking about here. The Lloyd's story reveals something profound about financial innovation. The same mathematical principles, risk-sharing concepts, and information systems that made maritime insurance work also laid the groundwork for stock markets and modern portfolio theory. Just as Lloyd's underwriters spread maritime risks across multiple participants, modern investors spread risks across diversified portfolios. Just as Lloyd's developed systematic methods for pricing uncertain outcomes, stock markets developed methods for valuating company ownership shares. The coffeehouse model of informal trading evolved into formal markets, and this would be repeated throughout financial history. Jonathan's Coffee House, located just blocks from Lloyd's, became the center for stock and commodity trading innovation. The same forces that created systematic insurance markets also led to the creation of systematic securities markets. Lloyd's Coffee House teaches us that successful financial institutions emerge when three factors converge. Number one, a genuine economic need. Number two, mathematical sophistication. You need math. And three, societal and social infrastructure for sharing information and building trust. These same factors drive financial innovation today. Cryptocurrency markets, peer-to-peer lending, and sophisticated insurance products emerge when new risks create demand for financial solutions, and mathematical tools become available for pricing and managing risks, and infrastructure develops to support large-scale coordination. Next week, we'll discover how these same principles of risk pooling, mathematical pricing, and institutional coordination gave birth to stock markets and the revolutionary idea that ordinary people could own pieces of the companies that drive economic growth. Until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is the Saturday Morning Muse. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public good with your friends, your colleagues, your neighbors, and maybe a family member. The show is produced by Nicholas Temte, and we'll see you next time on the Saturday Morning Muse.